It's Friday, 23rd of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, signs of improving China-India relations and what that means for the global economy. But first, the US economic and policy outlook. Between Jerome Powell giving his remarks at Jackson Hole and the next batch of US inflation data due on Friday 30th, Neil Shearing, our Group Chief Economist, spoke to Stephen Brown, Deputy Chief North America Economist, all about what's happening in the US economy and how we expect the Fed to respond.
We're talking just after Powell has spoken, and in case anyone didn't get the message from the latest set of Fed minutes, he all but confirmed that they're going to cut interest rates in September. Just looking through the speech that Powell gave, he said that the upside risks to inflation have diminished, the downside risks to employment have increased. He went on to say that there had been an unmistakable cooling in the labour market and that, quote unquote, they do not seek or welcome any further cooling. And I think in what's the weekend gift to headline writers everywhere, he said that the time has come for policy to adjust. So, cuts coming. What else did we learn? And I guess the key question really for markets is that not so much whether they're going to cut in September, but by how much. Did you spot anything on that front that stood out from the speech?
Yeah, I think it was almost more what Powell didn't say. So in the Fed minutes that were released earlier this week from the July meeting, it was clear that the committee had discussed the potential for a 25 basis point cut at the meeting in July. Now, Powell could have obviously repeated that sort of language. He chose not to do so, instead noting that the pace of rate cuts will depend on incoming data, the evolving outlook and the balance of risks. And as you said, obviously there was a lot more focus on the downside risks to the labour market. So I think that basically tells us that the Fed will consider a 50 basis point cut in September. That being said, though, the point is that it will depend on the incoming data there. We did see that rise in the unemployment rate in July. Our sense is that was driven by temporary factors. That 0.2% increase was due to a big spike in temporary layoffs. We've already seen jobless claims drop back. So in all likelihood, we'll probably see the unemployment rate stabilise or even drop back this month. So I don't think it's going to be clear cut whether we get a 25 or 50 basis point cut in September. Certainly it's going to depend on the totality of the data before then. The activity data is still strong, so we're still leaning towards a lower 25 basis point cut.
Yes, it struck me that he used this line that the timing of cuts will depend on the data. I mean, I have to say this drives me up the wall because the data they're waiting for, core inflation, employment, wages, I mean, at best, they are coincident indicators. Often they're lagging indicators. So in saying that we're data dependent and given the data they're waiting for, there's an inherent risk that they keep policy too tight for too long, isn't there? And in that regard, I think it's ironic that the title of this year's symposium in Jackson Hole is Reassessing the Effectiveness and Transmission of Monetary Policy. I mean, quite apart from the fact that it's not particularly catchy, it seems that central banks everywhere seem to be forgetting that policy operates with a lag. So what do you make of the balance of risks with respect to monetary policy? Have they left it too late, do you think?
I mean, probably, but I think the point for me is that, when we cast our mind back to the argument 1 to 2 years ago, the whole strategy of central banks really was to tighten policy to the extent that they were willing to accept these downside risks to the economy. It was only 2 years ago that Powell was suggesting that they would be happy to accept the risk of recession if that meant mission accomplished on the inflation side of things. So yes, they probably have left it a bit too late, but then again, I think that was always the strategy. What was quite interesting for me is this idea that we don't welcome a further cooling in labour market conditions.
Yeah.
And the emphasis on the rise in the unemployment rate so far has been due to kind of higher labour force growth rather than weak employment. But that's telling me that, they're thinking about maximum employment through the lens of the unemployment rate. So we don't necessarily need to see payrolls turn negative or even slow much further. We just don't want to see that unemployment rate increase any further. So it could be that we're still getting a soft landing because it doesn't look like the economy is about to fall into recession. It's just that the Fed underestimated how strong labour force growth was going to be. And so that affords it the ability to now cut interest rates maybe a bit faster than we were expecting without being too concerned about the risk of inflation rising again.
Yes, and I guess in fairness to central bankers, having criticised them for being overly data dependent, a lot of the inflation dynamics, as we've been stressing in our research, a lot of it's been driven by developments on the supply side of economies, labour force growth in particular, the recovery from the pandemic, how that's affected the supply side of the economy too, as well as it's not just immigration, it's about the recovery from the pandemic. So in fairness, it's quite difficult to get a handle on all of that. So we'll be fair to central bankers in that respect, even if I will continue to criticise them for being overly data dependent. Speaking of data, busy week ahead on that front. We've got PCE data coming. What are they likely to show us?
Yeah, so we've got the personal income and spending release. I think we've had the CPI data, the PPI data, and the import price data, which all feed into the core PCE price calculation. We think core prices rose by 0.16% on the month, which is marginally below the rate that's consistent with 2% annualized inflation. I think from a point of view of the Fed, most officials kind of are taking those estimates as if they're a given now. So that already counts as a good data release, even though we haven't had it. So the more interesting thing is probably going to be the real consumption number. So after the July employment report, where it was quite weak with that rise in the unemployment rate, we subsequently got a much stronger than expected retail sales release. So what we need to now see is whether that's matched by strong services consumption. So up to June, services consumption had been slowing, at least in 3-month annualized terms. So it'd be interesting to see whether that, it's possible that it actually continues to slow, which would obviously kind of negate the positive message we took from retail sales. Equally, it might be that overall consumption remains strong, and that would be another reason to think that the Fed doesn't really need to rush in with a 50 basis point cut.
Yeah, it's worth noting, isn't it, that we've just updated our GDP Nowcast with the latest round of data. That's collapsed. I suspect one point for listeners to keep in mind is that GDP Nowcasts are everywhere about to collapse. The Atlanta's Fed's Nowcast, I notice, is down for Q3 too. That's because the way these models work, they assume that kind of the weak activity data that we've had in July, like you say, related in part to hurricanes and that retooling at some auto plants that lasted a bit longer than in previous years. The models assume that that's sustained through in future months when actually we should start to see a bounce back. So keep an eye out for those nowcasts falling and then rebounding, I suspect, through the quarter. Just before I let you go, we should talk about the DNC in Chicago this week. We're talking on Friday. We had a speech from Kamala Harris accepting the Democrat nomination last night. Anything in there that stood out for you that was particularly noticeable with respect to the economy? One line that I took away is that she would ensure that America, not China, wins the competition for the 21st century. So whatever happens on the domestic economy, it looks like this geopolitical tension and rivalry between the US and China is not going to be going away. But what did you take from the speech?
Yeah, I mean, it was certainly a very energized speech. I don't think it's going to kind of do anything to change the recent momentum we've seen in the kind of the betting odds and the polling. We didn't hear a whole lot on the economic front. I mean, one line that did stand out was a pledge to deliver a middle-class tax cut, which kind of is a bit hard to square with the economic policies Harris outlined the week prior, which didn't mention a tax cut explicitly. It might be that that's just a different way of referring to the child tax credits that Harris had proposed. It could be that she's referring to this idea that the Democrats would seek to extend the 2017 tax cuts, but only for those earning less than $400,000 or so. So the idea that that's kind of aimed at the middle class. I guess much like many of these campaign speeches so far, it was certainly more style than substance. So we'll probably need to look forward instead to obviously the debate between Trump and Harris on the 10th of September to see if they go any further into some of the fine details of these policy pledges, although I wouldn't necessarily hold my breath for that.
That was Neil Shearing talking to Stephen Brown about the US economic and policy outlook. I will add relevant research links to the podcast notes, and do take a look at our US scenarios dashboard for timely probabilities of whether the US economy is in for a soft landing, a recession, or any other outcome. As with all our dashboards, CE Advanced clients get access to the available underlying data. We're going to be covering that PCE data along with the latest Eurozone inflation numbers and all of the key data releases in the coming week, with rapid responses, follow-up analysis, and then insight into their market implications. We've got a special week ahead calendar on the site showing you which are the key upcoming global releases and our economist previews of them. I will link to that in the podcast notes. Staying on the US, our commercial real estate teams just published analysis which makes the case for the retail sector's comeback following its decade-long hammering. I'll add that to the podcast notes too. And watch out for a special podcast that we'll be doing on this topic in the coming weeks. Now, signs of a concerted effort among Indian and Chinese diplomats to address their long-standing border dispute throws up all sorts of interesting questions around global fracturing. That's this multi-year geo-economic process to do with the breakdown of US-China relations that we've been helping clients understand. Following the 30th meeting of Sino-Indian talks on this border dispute that recently wrapped up in Delhi, our Chief Asia Economist Shilan Shah published a report which looks at the macro implications of how India, and actually EMs in general, align in a world of competing US and Chinese economic blocs. Shilan recently spoke with Chief Asia Economist Mark Williams about his analysis, and here's that conversation now. And it starts with Shilan talking about how meaningful these latest developments in Sino-Indian relations are.
Yes, I think some of the recent developments have been quite striking. India and China have had a long-standing border dispute in the Himalayas. Tensions there have been particularly high, really, since skirmishes actually broke out in 2020. But recently, the respective foreign ministries have indicated a willingness to find a resolution, and they've stated that they are in frequent dialogue as well. And there is some concrete evidence of this, successfully created 5 so-called buffer zones from which both sides have withdrawn their troops, and neither side is patrolling. And on top of this, Indian policymakers appear to be warming to the idea of more Chinese investment in the country. It was only really a year ago that the government blocked attempts from BYD, for example, to set up an electric vehicle factory in India. But I do think that there's been a notable shift in tone. For example, the chief economic advisor in India has been speaking about attracting Chinese investment and technology in order to boost India's manufacturing capabilities. And this type of sentiment has been repeated elsewhere by quite high-profile policymakers as well.
So what do we make of this? I mean, is this a sign that India has fundamentally changed its position and actually it sees its future as being a bit closer to China? There's clearly some economic benefits that it could derive, or could believe it could derive from that. Or is it actually, that the whole idea that countries pick a side in this geopolitical fracturing scenario, is that fundamentally, do you think, misplaced? Or what exactly is going on?
Well, I don't think it's unheard of for countries to shift their geopolitical alignment. I mean, even if we just look back in the past couple of years, a number of emerging markets, including Saudi Arabia, South Africa, have, in our view, moved towards China's sphere of influence with their own sort of strategic interests in mind. But I do think that the developments that we've seen between India and China probably doesn't, at this point to a fundamental realignment in India's position. I think the wider context is important. I mean, the border talks are still quite fragile, and really it only takes a pretty small military misunderstanding for the entire situation to escalate again. Beyond this, India still has quite deep concerns about China's military presence in the Indian Ocean and its close ties with Pakistan. And of course, it's notable that India is also a member of the Quad, which is the security dialogue that includes the US, Japan, and Australia. And I think probably the most important point is that even a slight warming in ties between India and China doesn't undermine the advantages of leaning towards the US in order to capture some of the benefits of friendshoring and supply chain reorientation. I mean, we've seen evidence of a really big jump in India's global share of mobile phone and semiconductor exports, which I think we can attribute, at least in part, to the friendshoring process. India won't want to be giving up those advantages.
And I think actually we can go further. That you can make an argument that it's actually by trying to attract in, for example, Chinese investment and have closer economic ties with China, that India right now is probably able to maximize some of the benefits of being perceived to be a US-leaning country. Because, of course, the goal here, I guess, in the long run is to establish India as being a global manufacturing base. Where is the know-how on manufacturing right now? It's clearly in China. So in order to kind of acquire some of that know-how, it's right that I think Indian firms, the Indian government should be trying to do what it can to attract not just the likes of Apple into the country, but also Chinese manufacturers as well. And maybe right now, countries like India are in a sort of a sweet spot where clearly there are these geopolitical tensions between the US and China, but it is still possible to have good relationships with both sides. That might not be true in a few years' time. It might be that the barriers come down much, much more. And then at that point, maybe the US will be pushing other countries to pick a side, say, well, if you want to do lots of trade with us, then you can't be using Chinese components in your manufactured goods and so on. But we're not at that position yet. So I do think that there is an opportunity right now for India and other countries that sort of somewhere in the middle to take advantage of this moment, to pull in know-how, to build up their manufacturing sectors using investment from China in order to build for a future in which that they can be a bigger supplier to the US bloc.
Yeah, and I think it's interesting that you mentioned other countries beyond just India as well. I think that there is something of a trend that seems to be forming amongst certain emerging economies. I mean, Morocco, for example, is benefiting from Chinese investment in green technology and EVs. And it also has Europe as a very large and very accessible market right on its doorstep. And it's similar, I think, for Hungary, which we classify as being loosely aligned with the US bloc, but investment from China into Hungary has really surged in recent years. I think it rose fivefold between 2022 and 2023, to the extent that it now has one of the highest stocks of inward FDI from China pretty much anywhere in the world.
Yeah, and some of this debate gets characterized as friendshoring, doesn't it? But I think that's a really good example of the way that friendshoring can be a bit of a misnomer in some sense, because, how do you think about Chinese investment in somewhere like Hungary? Is that friendshoring, or, Hungary's in the EU? As you said, we think of it more as still leaning towards the US bloc, but it is doing very well from attracting in investment from China. And there are other countries, as you say, that are doing the same thing. They're benefiting from the fact that they are friendly with the West to use that to attracting investment from China. And of course, it makes a great deal of sense for the Chinese companies as well, who are also looking for ways to get around either tariffs that the Western governments have put up now or tariffs that they may well put up in future. So it's a great opportunity in that sense for EMs to establish their supply chains in their countries.
Mark Williams and Shilan Shah talking China-India. Shilan's analysis goes into more depth on this issue, and it fits in with this broader look at the macro market implications of the breakdown in US-China relations. It's all on our Fracturing Hub, which I'll link to in the podcast notes. Neil will be back next week to talk through that PCE data and other global macro developments and to preview key upcoming events, not least August non-farm payrolls on September 6th. But until next week, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.